Good afternoon, everybody. Thank you for joining us for our webinar today with Pyra and our special guest, Trusaic. We want to thank Trusaic for sponsoring and providing the content for today's webinar, ACA Compliance Challenges in 2020 and the Increasing Enforcement Trend. And today, your presenter will be Joanna Kim Brunetti, Esquire, Vice President of Regulatory Affairs. Joanna, a former partner with Aiken Gump, has over 20 years of experience advising on a wide range of employment, tax, intellectual property, and other related business issues. Joanna holds a Bachelor of Science degree in Chemical Engineering from University of California, Berkeley, and JD from Loyola Law School with honors. And I will pass this on to Joanna.
Thank you, Brian, and good afternoon. So today we're going to cover, the ACA in all its glory. We're going to talk about some of the trends in the Employer Shared Responsibility Payment, or ESRP. We're going to talk about the new state filing requirements. We'll go into the details of some of the form changes and upcoming deadlines. We'll talk about the 4980H penalties and premium tax credits, how they're tied, and now what? We'll be discussing the importance of penalty risk assessments and discuss some case studies, and we'll leave some time for some questions and answers. And to the extent that any questions are not answered, I will provide written answers after the webinar. Okay, next slide. Okay, to start us off, we've only had a few years of ACA enforcement in effect. As you may recall, the ACA really was implemented starting in 2015, and then of course it took a couple of years before the enforcement efforts came around. But the employer shared responsibility trend, payment trend is upward, whether it's the CBO estimated, the IRS assessed, or IRS collected. And as you can see from that slide, all the angles are up. So with each year, there is an increase in the trend towards ESRP. Next slide. Okay, so what some of the things that are going into the increasing trend is that the IRS, is feeling more pressure to do more to assess penalties. The Treasury Inspector General, which is kind of the kind of inspector of the IRS, what they are doing is they're putting pressure on the IRS to do more to collect penalties after determining in their own audit that the revenues were just a small fraction of what the Congressional Budget Office had estimated. And so there's pressure coming from TIGTA. Additionally, the IRS has substantially improved this ACV reconciliation system, which is an automated way to identify penalties. And more recently, the IRS eliminated the good faith transition relief for upcoming reporting years. Previously, if an employer had could establish reasonable efforts to prepare and furnish, such as gathering and transmitting information to an agent to prepare the data for submission to the IRS, or doing the testing procedures, that could basically have certain late or inaccurate filing penalties waived, and that's basically been halted for future reporting years. Additionally, layering on top of that is the absence of a statute of limitations. And the net result means that, the IRS could come after an employer for ACA related penalties, indefinitely. There is no statute of limitations. And this is according to the chief counsel of the IRS. Another added pressure is the IRS is using levying procedures and collection agents to collect ESRP penalties. So all of these things are merging towards this increasing ESRP enforcement. Next slide. And of course, I would be remiss if I didn't mention how COVID-19 is complicating things. What the pandemic has done is, you read about it in the news, increased unemployment, and it's driving up healthcare exchange enrollments and its associated premium tax credits, or PTCs. What PTCs are the triggers that the IRS uses to assess an employer's 4980H compliance using their ACV system system, which has been improved. So the 4980H is the IRC section that it corresponds to the ESRP penalty. Those are the A and B penalties for not offering coverage or not offering adequate coverage. Additionally, with the pandemic, when you're applying the IRS measurement methods to determine full time, it gets more complicated when you have people furloughed or have reduced hours. You rehire them, terminate them, lay them off, etc. All of these things complicate the full time calculation. Really spurred by the COVID-19 pandemic, and this pandemic has been going on for the bulk of this year, and the impact of it has yet to be realized. We just know that it is going to have a big impact. And I already talked to you about the pressure that the IRS is feeling from the Treasury inspector. So when you consider that the pandemic is actually complicating things, the IRS is feeling pressure to improve and increase ESRP enforcement, what you're going to see is, more penalties. That's the bottom line. Okay, next slide. Okay, so that's on the federal reporting. So what is also going on are state level reporting, and it's not in all states, it's just in some states. But as you may recall, in 2017, through the tax and the jobs and tax cut, I'm sure I got that wrong, but it's a major tax legislation under the Trump administration that came out 2017, which got rid of the federal individual mandate. And with that void, what has happened is a number of states have taken upon themselves to create their own state individual mandate. And that individual mandate is essentially a penalty for a taxpayer not having not having coverage. And the penalties are very similar to what had previously been in place under federal law. So in New Jersey, starting in 2019, the employers now have to comply with state level reporting to address this individual mandate. So under federal law, the individual mandate went away starting 2019. New Jersey put it back in place, but at the state level. And in order to administer that and to make sure that individuals were, in fact, getting the required coverage, what New Jersey also layered was employer reporting to make sure that was going on. So, the format is essentially the same as the federal one, which is the 1094 and 1095Cs. But this is also reporting that has to be submitted to New Jersey directly. And the first year of implementation was earlier this year. So, and the penalty was very much what the federal law had previously specified, which is an individual tax penalty of $695 per adult, half that for child, or 2.5% of the taxpayer's household income, whichever is greater. Next slide. California, a year behind New Jersey, had it go into effect starting the 2020 year. And so as part of this individual mandate, California, like New Jersey, have required their own reporting to go to California's Franchise Tax Board, which is California's tax reporting agency. And the penalty is the same, the $695 per adult, half of that for child, or 2.5% of the gross household income, whichever is greater. The one additional wrinkle is that in California, individuals are eligible for the PTCs up to 600%. Federal, it's only up to 400%. So in California, there's more likely individuals that will get premium tax credits. Okay, next slide. Okay, Washington, D.C., also very similar. It has its own, the jurisdiction of Washington, D.C. has its own, employer reporting, essentially to make sure that the individual mandate is being complied with. And so it's very similar again to the ACA. It's not identical, as you can see. Okay, and the first reporting deadline was June of this year. Next slide. Okay, Massachusetts. Massachusetts actually had it in place since I think 2006. People might recall this as Romney Care. It's a different structure than most of the other states that created their own individual mandate, but it is an individual mandate in its own in its own space. And the penalty structure is very different, as you can see, and it's also an annual reporting. Next slide. Okay, Vermont also recently created their own individual mandate, and the one thing is they don't have the same, Vermont doesn't require employer reporting unless the ACA reporting mandate for self-insured, for example. This is under IRC 6055 for minimum essential providers to furnish statements to covered individuals is suspended or eliminated. Okay, next slide. And then lastly, Rhode Island also implemented their own individual mandate, similar again to the ACA individual mandate. And so as a result, downstream from that, employers have been required now to provide reporting to address that individual mandate like the other states. Now, next slide. Now, there are additional potential state individual mandates coming up. That's Maryland, Minnesota, Washington, Hawaii, and Connecticut. So there isn't one in place yet, but there is expectation that it'll be coming down the pike. All right, next slide. Okay, so that's the state, those are the state filings that are being layered on top of the existing ACA federal filings. Now, what you'll see on this slide is the 2020 IRS Form Changes that it's different than prior years. And what we've done is we've highlighted that last line, line 17, it adds in the zip code. And basically the reason for that is the Trump administration had allowed for these health reimbursement arrangements as part of minimum essential coverage by allowing employers to subsidize coverage for individuals who get coverage on the exchange. Previously, that hadn't been in place. So when the Trump administration had allowed that, it caused this trigger of a bunch of different codes that had to be incorporated into the 1095C forms. So you see codes 1L through 1S, and they're different permutations of how the individual has an HRA type coverage, and to the extent that that individual's spouse and dependent has coverage. So the zip codes in part helps align the affordability for those plans. And so that's part of the reason why the zip codes are also now required. Obviously, if the person's been there the whole 12 months, you have the same zip code. But if there isn't, then you're going to have to spell it out for each month. Okay, next slide. So with all of the federal forms and the potential state forms, for the states that are in place, you can see that the deadlines are very similar. Probably DC is the only one that's got the later deadline. These deadlines have largely been extended to match the IRS. Like in California, the deadlines is the same as the IRS, and if the IRS extends it, California will automatically extend it. But New Jersey and Rhode Island, it's not automatic. It needs explicit rules saying that it is being extended. So basically, you've got a March 2nd deadline next year for the 2020 reporting year, and then a March 31st filing deadline. The one outlier here is Massachusetts with its own very different healthcare coverage type reporting. Massachusetts has a January 31 deadline for furnishing its own reporting. Okay, next slide. Okay, so let me talk about the 4980HA and B penalties. And the two different penalties are the underlying penalties for coverage, for failure to offer coverage. So the 4980HA, that's what's called the sledgehammer penalty. That's basically triggered if an employer fails to offer minimum essential coverage to at least 95% of their full-time employees and their dependents. So this is the big one. It's essentially at the current rate for the 2020 year, it's a little bit more than $2,500 per employee. So if you have, the example here is if you have 100 full-time employees and you do not hit that 95% threshold, you're looking at almost 200,000 in penalties. And this is for an employer with 100 full-time employees, because you get the first 30, they're basically freebies. And this will be triggered if just one full-time employee gets a premium tax credit from one of the healthcare exchanges. And as I had mentioned earlier, with this, the COVID pandemic, more people are recognizing the need for health coverage. More people are going to the exchange. That's the bottom line. There's going to be more people receiving tax credits. And so employers are going to be more exposed to this A penalty. Now there's the B penalty and what we're calling the tack hammer penalty, because it's very targeted. It gets triggered if a plan doesn't meet minimum value or the plan is not affordable to the employer who receives a premium tax credit. So it is on a per employee who receives a PTC. That annualized rate is $3,860 per employee for the 2020 year. It increases every year, but it is on a per employee basis. And the A penalty is not on a per employee basis. So if you have 100 full-time employees and just one of them got a PTC for that year, you're still going to get the A penalty for all of the full-time employees. Whereas under the B penalty, if you have one employee that gets the B penalty, you only are assessed that $3,860 for that one employee. So that's the difference. Okay, next slide. Okay. All right, so let me talk to you about these premium tax credits. As I had mentioned, the premium tax credits trigger the IRS penalties. So what we're looking at is about 11 million enrollees in 2020. Almost 10 million received a premium tax credit. So what we're looking at is 87% of all enrollees on the federal health exchange received a premium tax credit. If you look at California, it's a very sizable portion of the entire pool. You have 1.5 million enrollees, of which 1.3 million received a premium tax credit. So California takes a big chunk of the federal, of the entire healthcare exchange pool. Not surprisingly, California, has the most people in the US. Okay, next slide. Okay, so who qualifies for a premium tax credit? This comes out of the Department of Health and Human Services. They issue this chart every year, and the 2020 mainland federal poverty line chart, you'll see up to 8 here. So if you're looking at a household size of 4 people, and let's say, one of the parents works, if that household makes up to $104,800, they would be eligible for a premium tax credit. So what you're looking at is, these are very much middle income type incomes that could qualify for premium tax credit. So it's not just the very bottom, low income. It's actually, can reach a very large proportion of the US population. Go to the next slide. As you can see, as I'd mentioned, California had 1.3 million of the premium tax credits for this year. Florida actually even had more, almost 1.8 million, even though Florida has a much smaller population than California. Okay, let's go to the next slide. Okay, so I wanted to talk to you about how these penalties get assessed and how easy it is to be assessed with a penalty if you've not complied. So here's a chart here. So let's say the employer fails to offer this affordable minimum value health coverage to one of its employees. That employee purchased coverage from one of these healthcare exchanges and receives a penalty, a premium tax credit. That healthcare exchange then sends that information to the IRS. And then the IRS, and that information can be sent through this 1095A that the healthcare exchanges have to report. So they take that 1095A, they compare it with a 1095C that the employer has to file, and then they figure out who gets a penalty and who doesn't. It's that simple. And obviously, if you aren't an applicable large employer, i.e. 50 or more full-time or full-time equivalent employees, you could be subject to this ESRP penalty. And if you are, the IRS is going to mail out a 226J penalty letter to you. Okay, next slide. Okay, so what they do, if you look at the form, the 1095A and the 1095C, that's the disclosure form that the employers have to give to all their full-time employees. 1095A is what the healthcare exchange will file. So the IRS gets both these forms, and all they do is just use the social security number, and they figure out from lines 14 and 16 on 1095C with lines 21 down on the 1095A, and they can figure out bada bing what the penalty is. And that's what that ACV system does, is it, very readily resolves it and reconciles what the penalty should be. Okay, so let's go to the next slide. So all of this, and so so now what? Well, there have been employers who use do-it-yourself software, but even if the software works, people and processes will often fail. So if you look at the software itself, they take the payroll, human resources, health benefits, time and attendance data, because those are sort of the four sort of areas or data sources. And what's required is you take that data on a monthly basis and you resolve from all of those who gets an offer and for what. And I had mentioned affordability earlier, and what I didn't tell you is exactly how that's calculated. The sort of baseline is this 9.5% of an individual's household income. There are safe harbors that an employer will use, and those safe harbors are typically either based on the W-2 income or the pay rate. So you take all that information and you calculate and you make offers on a monthly basis, and then annually you report it. So where can things go wrong? Well, this is where the people and process failures come in. When you're looking at it from the data source, there's missing zip code information, errors in Social Security, typos in that data, and so the reconciliation process doesn't happen. So there's also control group analyses. If you're a smaller size employer, but you have affiliated companies, under the IRS, there are certain control group rules that require you to consolidate those affiliated companies so that that group, that aggregated group, is what the 50 plus full-time or full-time equivalents is based on. It's not just each EIN. So that these are things to kind of watch out for on the sort of data source line. So with that, the errors that happen, there's no control for reconciling inconsistencies between these sort of disjointed data silos. So I had mentioned this missing hire dates, hourly salary status, and there's, names are spelled differently in different data silos. There's human error in identifying Social Security numbers, for example, birthdays, what have you. Higher term dates aren't matching, and so that doesn't resolve on a sort of an automated software. Like, for example, if an employee was on leave and the software or the payroll or time and attendance software that's already in existence, you may have that person identified as rehired, but really they were just on leave and they're back. So these kind of things, that kind of sophisticated data description that is specifically for the ACA, the existing software systems don't have that. And so basically these kind of errors can result in being out of compliance and inaccurate reporting. Okay, so next slide. So we did some case studies for a number of companies, and what we found was these errors that would happen. In this slide here, you'll see they were assessed a $2.3 million penalty. We went through their system and figured out where the errors were, and at the end of the day, we reduced the penalty down to $650,000 based on what their data actually showed, and basically resolving errors that happened when they used their software. Next slide. Okay, here's another one. This was a school district in California, and they were potentially exposed to they had a $6.4 million exposure, and we were able to reduce that down to 1.2. So, at the end of the day, with a 4980H penalty, if in fact the employer didn't offer coverage to the 95%, and you can't show that, then you're gonna get tagged with a penalty. But in a lot of times it was much worse than that, or at least that's how it looked. But if you can document and substantiate that the penalty shouldn't be so high, you will find that you're able to reduce it. Okay, next slide. Okay, here's another company, a behavioral health company in California. We were able to reduce almost 50% of their penalty. Okay, and next slide. Staffing company went from 808,000 down to 42. Again, this is another company where there were problems with missing social security numbers, missing hire and term dates. And so the software just kind of did what it did. And it came out with whatever was reported. They filed that with the IRS, and the IRS ran through their ACV system, and it cranked out an $808,000 penalty. And so we were able to go back and clean up the errors, and it was reduced to 42,000. Okay, next slide. Okay, so what we found was, doing a penalty risk analysis, it really kind of shows you what the potential risk is. This is on the 4980H penalty. So this really gives you a sense of using DoItYourself software to do the reporting. I mean, a monkey can fill out the form and it will get reported. But the question is, was it done correctly? What we found is that in the range of 500 or less employees, what we found that the average penalty exposure based on what was reported was 122,000. If it's between 1,000 and 5,000 employees, the average penalty exposure was 1.4 million. And so on. So if you look at it from a maximum IRS 4980H penalty, depending on the number of full-time employees, you can see that the maximum penalties are huge. So the maximum penalty for 100 employees, the maximum penalty is 257. If you've got 10,000 employees and you're subject to that maximum penalty, we're talking about over 25 million. So these are huge, huge dollar amounts. It's not trivial, and you want to make sure that what you're reporting is accurate. Next slide. Okay, so what can you do? Well, you want your organization needs to be proactive now to avoid penalties. So you want to first figure out what the risk is. So if you are a producer or account manager, you're going to want visibility into your client's ACA compliance. If you're an employer, you want visibility into your own potential risk. So, one of the issues is when you get the penalty letter, that's the dreaded letter 226J, you're going to be under considerable strain to get together justification for the penalty, or justification as to why the penalty shouldn't be assessed, because you have 30 days to respond to that letter. And what we've seen is, 2015 penalties, those penalties were assessed, sometime 2017. Starting in 2017. They are still working on 2018 letters, and we're now almost in 2021. So, you're going to want to have that kind of, you're going to need that kind of continuity with the HR folks to have all the data, the people who put the data together to explain why the numbers are the numbers that were reported, and you got to do all that in 30 days. So, what you want to do is just check now for your prior years. As I'd mentioned, there is no statute of limitations. So, theoretically, 10 years from now, the IRS could come a knocking asking what was going on, in your 2020 reporting year, and you're like, gosh, I have no idea. So you don't want to be stuck in that situation. Okay, so next slide. Okay, so what do you do if a penalty risk is identified? Well, you obviously want to ensure robust compliance on a going forward basis. And there's certain industries that are really, very susceptible, that, large hourly wage, variable hour, employee type industries, high turnover industries where there's a lot of people rotating out, where a lot of people don't even last a year. Those are the most vulnerable type of industries that could get tagged for ACA compliance. You want to maintain an excellent document retention protocol so that should you be audited, you're ready. You have the documents that you need to support whatever penalty you think shouldn't be assessed. And right now, looking at it, like, you want to know, well, what did you just report for the 2019 reporting year, which came out, the filing was, earlier this year, and around the March 2020 timeframe. You submitted it, and the 2019 reporting year has not yet been processed by the ACA for penalty purposes. So, you might want to check to see, well, was that done correctly? And if not, correct it. So, get ahead of the potential 226J letter, or get all the documentation together to be ready for that. Okay, next slide. So we conducted this penalty risk assessment for a number of our clients and our broker partners, and this is what we saw. So overall, we saw a risk of over 53 million for the clients and broker clients that we had looked at. And what we're seeing is this was actually the risk that the penalty risk prevented, over 53 million. So it is very helpful to conduct the penalty risk assessment and do what is available to eliminate or minimize that risk. Okay. All right, next slide. One thing I wanted to mention is, pay equity really kind of has now sort of encroached into the health benefits in the ACA. So under the Obama administration, gender discrimination included termination of pregnancy or gender identity. And what happened was, under the Trump administration, there was a new rule announced that limited gender discrimination just to female and male. And then most recently this summer, the Supreme Court ruled that includes folks in the LGBT status. So what the bottom line is that brokers and vendors have to be more aware of healthcare coverage issues involving discrimination in the LGBTQIA that may also trigger civil rights lawsuits, investigations, and penalties. So it's something also to keep in mind as you're trying to maintain ACA compliance. Okay, next slide. So we have our first poll question. Have you or your client assessed your ACA related IRS penalty risk? If we could launch that first poll. Okay. Now, as I talked about, it's really important to know what your risk is, and if you do have risk, and that risk can be reduced, you have a way of, sort of addressing it now before you get the 226J letter. I have the results from the first poll question, and what you see is that almost 80% have not done this ACA related IRS penalty risk assessment. It's really important to know, if you don't do this assessment, you have no idea what you've reported and what the outcome of that is going to be. You don't want to wait until you get the 226J letter. Okay, next slide. Okay, next slide. So poll question number 2, approximately what percentage of your workforce is hourly? Okay, I'm going to await a little bit before we get the results, or kind of all over the place. And I think they're kind of evening out where it's, basically anywhere from 0 to 100%. It's kind of all, you got folks in every category. What I think is, valuable, the biggest one is 50 to 75%. What I think is important to note when you're dealing with a large hourly workforce is that their hours are constantly changing. And so you may think you've hired someone ostensibly as part-time, but, somebody gets sick, especially now in this sort of COVID environment, this becomes an issue for essential workers. People who need to be there in person or even remotely, people not being at work and, someone taking on another shift. Under the ACA, full-time is 30 hours per week. So if you have folks working normally 25 hours a week, you're thinking they're not full-time, they aren't, they are not subject to being full-time under the ACA, and hence they don't need an offer of coverage. You might find that that's not the case. There are 2 different ways to calculate whether somebody is considered full-time, and under the look back you can use history to determine someone's full-time status, so you have more predictability in determining who's full-time and who's not. But if you haven't done that, which means that you're essentially defaulting on to the monthly measurement method, where each month the person's status can change, and healthcare coverage being the second most expensive labor operating expense, and as a result, healthcare coverage, for example, only being offered to full-timers, that could cause you to be in non-compliance with the ACA. Okay, next slide. Next slide. So what is your approximate annual workforce turnover? In other words, what you could, as a percentage in terms of the folks that leave on an annual basis. Okay, maybe I didn't ask that question clearly. So what is your approximate annual workforce turnover? So I see, and while the results are coming in, I see it's mostly pretty in the 0 to 25%. I'm going to end the polling now. So I think 50%. Oh. Yeah, it's going to basically stay approximately the same. So we're seeing that 65% are in the low turnover range, so under 25%. So that's good from the standpoint of the more turnover you have, the higher risk you have where you could have issues with not offering coverage, making sure that you are, ensuring that monthly offer of coverage being provided. Okay. Next slide. Okay. So with that, I'm going to go to questions. I see, let me see if I can find
Hey,
some of these.
Joanna, I'm sorry to interrupt, but while you do that, I want to ask one more question of the audience here.
Okay.
And I'll put a poll up as well. Would you like to receive a free ACA penalty risk assessment for your client or organization? So I'm going to go ahead and launch that poll, and you guys can answer at your leisure. Thank you.
Okay, so let me get to, it looks like I'm not going to be able to answer all of these questions live. So I'm going to, go back and put them in writing. Either it's going to be posted on Pura, or if you give me your email, I will get to providing you a written response. Okay. A question was, do filing 1095-Cs on paper slow down the assessment process? The answer is probably. I don't think they're officially making that, announcing that, but the paper filings, unlike the electronic filings where basically they're doing it on an automated process. So I'm guessing that the paper filing will slow it down. It won't avoid it because, there have been employers that did submit paper filings and they did get an assessment. So it isn't impossible, but it does seem like, obviously, with the ACV system being what it is, it's all automated now. I presume they can scan these paper filings. And as you know, the paper filings are limited to 250, less than 250 returns. So if you have, if you're over a certain size, you're not going to be able to do paper filings. But if you do paper filings, it isn't going to eliminate the penalty, the risk of penalty, but I suspect that it does slow down. But as I said, the IRS has certainly not made any announcement on that. Okay. Here's another question. So what happens if the employee informs the employer that they have other insurance, therefore not enrolling on the employer insurance, but in actuality, the employee went and purchased insurance through the marketplace? Does the employer handle something like this? Well, we've seen the situation many times. Typically, when an employer receives a letter 226J identifying that individual, the employer can respond and show that the employee declined qualifying coverage and thus show that the employee should not have received a PTC. One of the sort of flaws of the employer mandate implementation is that initially it was designed to have the exchange give the employer an opportunity to challenge someone getting a PTC. And I want to say, I think for the 2015 and 2016 years, they did some of that where the employer would get a notice saying, hey, such and such person got a premium tax credit. If you want to challenge this here, submit this, that, and the other thing information. And they really haven't done that lately. And what it's happened is it's basically gone straight to the IRS, and it's the 226J is the first time the employer becomes aware that an employee who actually got the requisite offer of coverage went ahead and got a premium tax credit. And now this isn't to say that the employee had done anything nefarious, filling out the information to get the premium tax credit. It could have been they just made a mistake. But at the end of the day, the employer is going to get tagged with a penalty for that mistake. So, the original structure as envisioned by the employer mandate was to give an employer sort of two bites at the apple. One at the exchange to remedy an erroneous premium tax credit so the employer doesn't get penalized for it. And then a second opportunity with the IRS, but now it looks like there's just that one. So the IRS 226J letter is really the only time that an employer can challenge. So that's why it's so important to conduct a risk assessment now, figure out what the penalty is, if any, and also to make sure you get your ducks in a row in terms of documenting all the support to show that you did offer it to 95%, that the offer of coverage was affordable, met minimum value, etc. So having that documentation available in a sort of centralized location should the IRS come knocking is really important. You want to do that for each year since the 2015 start of the employer mandate. And as I mentioned, there's no statute of limitations. So, theoretically, you're going to want to keep that indefinitely. So that's kind of, why I wanted to really emphasize the importance of the risk assessment, figuring out what that is now. As I suspected, we've run out of time. There are a bunch of questions that came in, and I really appreciate that. I'm going to go ahead. We're going to gather all those questions and make sure all of them are answered in a written format. And so I think that's it. So back to you, Brian.
Great. Thank you so much, Joanna. I want a special thank you to Joanna for her presentation today, the great content. Also to Trusaic for partnering with us on this webinar. It's been a real pleasure working with you guys on this, and hopefully we can work together in the future to bring more content to the PIRA community. I want to remind everybody as well that we will be sending an email either this afternoon or tomorrow morning that will include a link to the recording of this webinar, along with the slide deck. So you'll have that to reference. And as you can see on the screen in the slide deck, you'll be able to get in touch with Trusaic and Joanna for any additional questions. Thank you all so much for joining us today, and we hope you have a wonderful afternoon.